Okay, guys, this is welcome to the chapter 8 today. Chapter 8 is in regard to money and banking. This is using what we call it the principle of macroeconomics. But if I can say Uzoka at Sheridan College is the publisher. Okay, it's an 11 edition. This is owned by McGraw-Hill. All right, I'm gonna put my screen here a different way here, so you can it doesn't disturb anybody. Okay. All right, let's start this. The mini banking side, we have a three learning objective. We have discussed on the last week the project of the to find the best bank in Canada that you want to have your business with or interest rate. So today we're gonna discuss the learning objective this chapter, which is related to last week project. Learning objective, which is one, describe the function, characteristic, and history of money. Number two, explain what is and is not money. Describe the main function of modern banks as money lenders. Number three, explain how small the amount of cash can support many loans and create more money. Let's go into dive in the objective number one. Money function is the characteristics and history. What are the function itself? Now, okay, there are money serve three important function. The first one is called the medium exchanges. In intermediate used to facilitate trade which avoid inconvenience of a barter system. In the old days, we always use a barter system. Now, but these days, we are using money as a chance of exchange. Number two is store wealth. Allow people to hold and accumulate wealth. The money is actually first created by Chinese in the 8th century. I can't remember the exact date, but they have started the paper money. That's how it goes. Started with the different. They started with a different accounts such as gold as well as tin and other materials, but it's being used now as a store of wealth as well to allow people to hold and accumulate wealth. Okay, and then number three is that unit accounts can be used to value goods and services, record debt, and make calculations. What are the characteristics of money? Accepted by general public, durable, portable, divisible, standardized, easily recognized but not easily copied, controlled by central authorities. Okay, control usually done by central banks. Now, in terms of ceremony, one group invites another to ceremony and give gifts, exchanging, expecting the favor to be returned in the future. That's the history of money. Eventually, note we are made of who own whom. That's the history. And then it started with the barter, trading one good and another. The widely valued good can eventually become commodity markets such as salt, beds, and gold. That is the standard way. And the oldest is always gold is the standard. In every civilized society from China, India, and Jewish, and then Arab, is always is gold is the key. Excuse me. History of coin gold started at 700 BCE before Christ, led to the standardization of weight, could be frozen, mixed with cheap metal, and then can use to can cause inflation and debasing currency. Okay, and then the history of money is paper money, certificate deposit, exchange is 13th century. It's an IOU from a reputable person for deposit wealth or to allow for future payment. Could be exchanged with other as paper money. So that's how it goes. Start with a paper money. IOU. The Chinese has started in the bank usually. That has I believe, but I'm gonna get back into you in terms of the detail side. And then the merchant bank is on the 17th century, printed their own paper money for others to use, could be redeemed at the bank. And then in the 19th century, it started with the checkbook, instructions to a bank to transfer money. Last Bank of Canada, 20th century, government took over all currency production since 1935. The Bank Canada issued a fiat money, declared the money by law. Okay, and this is the Bank of Canada. Now, types of money, there's commodity money, coins, paper money, checkbook money, bank deposit, and digital money. What are the things? This is the shells here, gold and silver, coins, paper money, checkbook, and digital money. Okay, what are digital money? This is the trend, like it's like bitcoins. Okay, that is but this is Now is no get digital coin has been gaining more popularity because it has been widely used everywhere and there's no restrictions, and has been used for many money laundering activities by uh, uh, by some high net worth individual, and even because this is the why it's so popular for digital money, because it has no traceability. It has no, it's a lack of in terms of regulation side. History of money: the fractional reserve banking. People usually write checks and don't take out in the actual cash currency. Bank loans out of excess reserve can earn interest. They retain a fraction of their deposit to cover cash withdrawal. This leverage allows greater rate of return for the bank and get more interest. That is basically the history of money. And what is the money? Money is, let's know for objective number two, it is a widely accepted medium exchange to buy good and sell debt. Money supply, this is, remember, money supply. Today in this project, after this presentations, you're going to do a project to find the current existing Canadian economy conditions. One of them you need to touch is the money supply. What is money supply? No one single accepted measure. What is the M1? M1 is the currency in circulation plus demand deposit of all chartered bank. That is called the M1. The M2 is equal to M1 plus notice of personal term deposit of all chartered banks. That is called the M2. The M2 plus is the M2 plus deposit at near banks. Okay, M2 plus, or we call it M2 plus, Canada saving bond and mutual fund. Sometimes people call it the M3. Excuse me. Financial institution. Who are they? Act as intermediary between household, business, and government that have funds available for lendings, and others who want to borrow those funds. There are two categories: the bank and near banks. Last week, we have a project regarding to find the best bank in Canada. The bank that you want to borrow your money from and get your interest rate for in terms of credit card as well as mortgage. Okay, so what are these banks? In Canada, there's about 8 of them, the big ones. Let's discuss. Look at this. Chartered Bank, Canadian Commercial Bank, which have received Chartered Bank Act. There's Big Six. Okay, big, not Big Eight. Big Six, the actual one. What are the Big Six? I used to work for BMO. BMO used to be number four. Uh, Number one used to be RBC. Now it's TD. RBC, TD, and then CIBC, Bank of Nova Scotia, Bank of Montreal, uh, and then you have Laurentian Bank, National Bank, and other smaller bank. Okay. Now there's an EQ bank as well. There's a near bank or non-bank financial intermediaries. These near banks, such as credit union, trust company, mortgage loan association, not defined by the Bank Act. Checking deposit. Deposit can demand their deposit in cash anytime. A saving deposit. Deposit may need to give notice to the bank before making a withdrawal. Non-checkable deposit. So you always remember, when you open an account in the bank, you always have two. The first one is checking deposit. You do it for your daily activities, buy and sell of things, or you doing a daily transaction routine. Okay, like buying grocery, buying foods, getting your salary. Saving and deposit is basically for you to save on your personal income. Personal term deposit. In terms of time deposit, they put a strict term such as 6 months. Okay, those are the things. The money here, example M1 to M2 plus plus, it's called the currency is here. This is the one. This is called, and then bank and check deposit. So you got the M1 here. Okay, this is the one. Okay, and then you got the bank, the saving and deposit. We call it the M2 here. This is all the company for the M2. And then the near bank checking and saving deposits will be M2 plus. And then the last one we call the M2 plus plus, Canadian saving bonds, which is 1532 here. The whole thing. Some people call it the M3. All right. The growth of monetary aggregates in Canada, 1979 to 2022. So you can take a look here. All different types of money. They have increased over the past half century. Canadian savings bond and bank checking and deposit increasing the most. Look at this. Canadian saving is the blue one. Okay. And then you have the red one, which is the bank checking deposits. And the green one is called bank saving deposits. And then the yellow one near bank deposit. And then you have the currency here. So this shows you a detail how it goes up eventually. It's the trend of going up and down. Okay, there's always a dip here because of tightening up the money supplies. But the trend is going up here. You see all of them. What is the money? Not included in money will be currency in the fall, such as bank, gold, financial securities such as stock and bond, checks, credit card, and debit card. Those are not included in the money. In terms of wealth holding, and there's a money or wealth holding, which is money here, currency, checking account, deposit, saving account. What is the currency will be contains note, checking will be deposit in checking account, saving deposit will be deposit saving account. In terms of financial assets, there's term deposit. What are term deposit? Which is fund deposit at a fixed period, usually short term at certain interest rate, and there's treasurable. Short-term security, specific denomination issued by federal government. The largest investor used to be China, but now China has been divesting into treasurable. China and the other six nations has created what we call it BRICS, BRICS. B stand for Brazil, R Russia, I is in India, C is China, and S is South Africa. The BRICS. BRICS, 5 nations, not six, okay? 5 nations. Now, but the membership has expanded. They have recruited Saudis. There's a number of Saudi Arabia. We have seen a slow moving from the de-dollarization of the world global dominance here. And then we have bonds, securities IOU issued by the government of Canada, saving bond and corporation at a fixed rate interest at a fixed term, okay, for one of the 10 years. And then we also have, we call it the stocks. It's a part of a corporation entities, the owner to claim of its asset and profits in the form of dividends. And then we also have the mutual funds, which is part of the owners of a fund that has invested its client money in various assets, including the share in corporations. You also have a GIC, which is a guarantee investment security. Certificates issued by financial institutions. And also we have the real asset, which is a personal asset, ownership things size, cars, boats and jewelry, and real estate. Okay. And then what's your understanding here? If David deposit 240 cash in the checking account at the commercial bank, has the money supply changed? Yes, of course, right or no? Look at the test. Remember here. And then if later David transfers his 240, yes or no? Number one. Number two, if later David transfers his 240 from his checking account to saving account in the same bank, has M1 changed, has to M10? Yeah, look at this first question first, okay? If David deposit 240 cash into his checking account, so it's basically the amount of inscription has decreased, but the amount on the deposit increased, but the total is the same, okay? That's number one. That's the one question will be like this. If David deposits 240 cash in his checking account at the commercial bank, has the money supply changed? The answer will be no. Why? The amount of circulation has decreased, okay? But the amount of deposit increased, but the total is the same. So that's the key part, okay? Number two, if later on David transfers his 240 checking account to the saving account in the same bank, have the one have changed to how about M2? So remember the definition M2, M1? Yes, M1 has less because checking deposits decrease, but M2 does not change because although there are more saving there are now less checking deposits. Okay, that's the logic there. Okay. All right, let's test your understanding again here for the next one. Given the following data in billions, coins is 13, deposit near bank is 137, checking is 72, can saving money market 320, savings has over 15, notes 27. What are the value of M1, M2, M2 plus, M3 trades? So what are the value? Let's look at the logic. look at the calculation. Get this number. How much is the M1? The M1 will be 112, which is the coins, which is the coin here, plus the notes, which is the notes, okay, and demand deposit, okay. That is the one which is 112. Coins, demand deposit. And then the M2 will be 327, which is M1 plus notice of personal term deposits. Okay, notice and personal term deposit. This is the notice and term deposit. Notice and personal term deposit. So 112 is coin, notes, which is notes here, coins, notes, and demand deposit. Okay, this is the one. Okay, here plus here plus here. Okay, that's the key. M1 coins, 112. This is the coins and the notes and the demand deposit. Okay. All right, let's do that again. The next one. What are the values of M1, M2, M2 plus? So of M2 will be 464, which is M2 plus deposit near bank. This is deposit near. Remember we have the M2 before, which is 327 there. You're gonna add 327 with deposit near bank, which is this one. You got a 464. And then the M2 plus, which is equal to M3, which is 784. Where you get it from? From here. Plus Canada saving bond. This is the one. Okay. Okay, go back again to the logic slowly so you can understand. This is your first given logic. Coins, deposit near bank, checking deposit. So what are the value gonna we ask M1, M2, M2 plus or M2 plus plus. So the first one, which is M1, which is coins, notes, and demand deposit, we get 13 plus 72 plus 27, you got 112. That's the M1. And the M2 will be the M1 plus notice of term deposit. What is the notice of term deposit? Okay, personal term deposit, which is this 112 plus this one 215. Okay, then after that you're gonna add the next one, M2 plus, which is 464, which is the M2, the first one M2 plus deposit nearby, which is here 215. Okay, so you have to add 2327 plus 215. Okay, and then after that the M2 plus, which is the M2 plus Canada saving one, which is 320. 464 plus 320, that you got 784. Okay, how it goes about. Okay, now the Canadian banking system, the bank most of their profits from interest on the loan. Okay, that's how they make profits. So you get a mortgage from bank, then the bank will get their money profits from the interest. Spread, the difference between interest rate a bank charges borrowed and the rate it pays savers. Okay, target reserve ratio is the fraction of deposit that a bank wants to hold cash. The creation of money by the banking system. Number one, how are you going to do that? Creating money, what company owns what is owed to. Liability, what a company is owes. Net worth is the equity, total asset minus total liabilities. Target ratio is a ratio, the portion of deposit that bank wants to hold in cash. Target reserve equal to target reserve ratio times demand deposits. That's how you get that number. Liquidity statement, example here, creating money 20,000, 20 million. Okay, so you got here the whole 120. You got here 120, so also get 20 million here. Okay, reserve, loan to customers, securities, and fixed asset. You got the money deposit here, 100 plus 90,000, you got 120,000. And then excess reserve, reserve in excess of what bank wants to hold its target asset, which is excess reserve equal to actual reverse minus target reserve. So every time the bank issue a loan, it creates money. So that's the key part. And every time the bank issue a loan, it creates money. If there's a new deposit of 1,000, the demand deposit increase as do as the reserve by 1,000. So if there's an increase of new deposit by 1,000, let's say you deposit into bank 1,000, then the demand also increase 1,000. So that's how it goes in terms of banking activities in creating money. So target reserve will be 10% times 101, which is 10,100. That must be held by the bank, and excess reserve will be 11,000 minus 10,100, which is 900. That can be loaned out. So not everything out of 1,000, only 900 can be loaned out. The 100 will be reserve. Okay. So bank uses a reserve to make loans. Loans usually eventually deposit, create new money, and first continuity and no more excess reserve. So that is how you're gonna go about reserve. All here the loans, this is all the deposits. Okay. What are the impact will be? We call it the money multiplier. It is the increase in total deposit that would occur in the banking system as a result of new deposit of a single bank. Sehingga example money multiplier, change the deposit divided change the reserve. The bigger the target reserve ratio, the smaller the money supply multiplier. The smaller the target reserve ratio, the bigger the more money supplier. Money multiplier equal to 1 divided by target reserve ratio. So how are you gonna go about? Assume that the banking system is over reserve for 20 million. What is the value of money multiplier? What is the maximum possible expansion with the money supply? The target ratio is 10%, 2%, and 5%. So you're going to calculate this based using that logic given to you. You're going to get 1 divided by 1/10, which is 10. 1 divided by 0.2, which is 50. 5 with 1 divided by 0.05, which is 20. So expansion will be 10 times 20, which is 200 million. This way 20 is coming from here. This 10 is coming from here, okay? This is 20 coming from here, and that's 50 become 1,000 million. This is 20, 20 is 400. This is how we call it the system multiplier effects. Okay, and then it's also work in reverse. If under reserve, you reserve it, under reserve it, the bank can call in loans decreasing in terms of deposit. The money will be smaller if the bank increase their target reserve ratio and people hold more cash. There are insufficient creditworthiness for the loans. People do not wish to take loan, for example, in terms of recession. That's what happens. Okay, during the COVID area, there's a lot of people do not have a lot of cash, so there's the decrease in terms of deposit. Okay, because of the many people lost jobs, so they have to use all their savings to fulfill their daily needs, daily expenses. So what are the key concepts in chapter 8 here to remember? Is the first one is the function and characteristics of money, and the type number 2, types of money and fractional banking system. Number 3, what is and is not the money. Number 4 is the main function of bank as money lenders. Number 5 is how money is created through deposit lending. That's basically conclude all the chapter 8. So I'm going to post this in YouTube. I'm also going to post it in Edpuzzle, so you can use this as your base to study again in terms of the banking, money and banking for your macroeconomic class. Hopefully you enjoyed this video. Thank you.